So now I'm going to try to put this all together in a way that you can get to stock price. And I'm hoping you can see from the information we've done so far about how you're going to calculate stock price in this model. Now what this is this is the forecast for the next 10 years. Now again, remember this forecast was based on historical values. You collected a whole bunch of historical values, you split it up by division, you then forecasted it by division, and you tried to find a good fit for a model that would forecast out 10 years. Then you added it for each of these years, you added up the divisions, you added on interest rate, and you had a forecast now out 10 years. Now the thing you have to do at the end is you need to think, well, after 10 years the company is still worth something, so there's going to be some kind of salvage value. And what we're assuming is the salvage value is equal to the cash flow in this year, 2022, divided by this discount rate. Now we don't really have a discount rate yet, but we'll just assume something like 6%. And we'll make that a variable in your Excel spreadsheet. So we have now all of these because you did a forecast and then you calculated it out. Now this is going to be in an Excel spreadsheet. Each of these values are going to be in there, and the ending value that will be this cash flow plus the salvage value. After that, now all of this is the cash flow from the assets. So once you find the present value of these cash flow using engineering economy and using the discount rate you've chosen, now we're going to fool around a little bit with the discount rate, so you want to make sure that's an input into your spreadsheet. But you choose a discount rate and then you calculate the present value. Then you subtract out the debt, the current debt, the 2012 debt, because this is present value. So we want to know the present value of the debt. And that'll give you equity. Now you have the total equity. In order to get stock price, you divide it by the number of shares, and then you have the stock price. Now, what you want to do is from this model, you'll get a particular stock price. And you want to see, well, what is the actual stock price? You want to build a model that will predict the actual stock price. So the things you can move around in order to try to fix that stock price initially are the forecasted values or the discount rate. And so I want you to try to think on trying to adjust these two values to try to get the calculated stock price equal to the stock price in the market. And that's the sort of the whole of what we're trying to do with this model. Now again, we might actually add something else later on to the model to try to look at if we still are quite a way from the actual stock price. There's some other things we can do, but that's the initial value, the way we're going to do it anyway.